All right. Good afternoon, everyone. My name is Jason Hamilton. Thanks for joining us this afternoon with the Stockyards Bank Bright Ideas series. Hard to believe I've been doing this, hosting this for about 12 months, or I'm sorry, about 10 months. So we're getting close to a year, and it's been almost a year ago that the COVID-19 kind of first broke out, and as crazy of a year as it's been, it's actually flown by. But I'm looking through the list of participants. I see a lot of new names or names that I don't see on a regular basis. So it's good to see some others tuning in. Again, standard housekeeping for today. If you've come on, you should be muted, but just double check that you are muted. We'll do questions at the end of today's presentation. Probably what I'm going to do is I'm going to kick it off, and we're going to kind of talk through some things that we commonly talk about. That's the markets, and Damon Massey, one of our investment advisors, will lead you through that. The nice thing is Damon is one of our lead cohorts with the investment team, so you're going to get it from the horse's mouth per se of what's happening. He'll kind of take us through 2020. Again, a quick look back where market returns came from. What sectors, exactly where those came from, it wasn't all tech, and he'll talk about kind of how that market return broadened at the end of the year. He'll take us through how government intervention kind of helped with the market returns, and then he's going to end it up with probably what a lot of you really want to hear, and that's what are threats to the market for 2021. But what's supporting the market for 2021 also. And then once Damon's done, Alex Say, our trust counsel, and he's our wealth planning specialist, he's going to come on board and take us through what estate tax changes can we expect under a new administration, a completely democratic government, and the ambitions that they're going to probably, try to come out with some of their new policies, and he'll walk you through that. So with that said, again, questions, we'll save them at the end. Please check to make sure you're muted. And Damon, I'll let you share your screen and take over.
All right. Well, as Jason said, thanks for joining us. It's good to see a lot of familiar faces out there and familiar names on the webcast. I'm glad to be joining you all today, and I am getting to my screen share there, so hopefully there we go. All right, so let's again, as Jason said, I'm going to walk you through a little bit of what happened last year. I think everybody, I'm not going to get into too much of a history lesson. I think we all know all the craziness that went down last year, but then talk about just what kind of shape the economy's in now, and a little bit about what we expect going forward. So first, let's just take a look at what the market returns look like last year. Really, if you just look at these numbers, you think, wow, that's fantastic! What a great year! But the majority of the return in the market came really in the last couple of months of the year, if not all of it, with the exception of maybe the NASDAQ here. So the Dow was up close to 10%, the S&P was up 18%, the NASDAQ, which is really top heavy with a lot of the big tech names, up 45% last year. How awesome is that? International benchmarks, the EFA, the Europe, Australia, Far East Index, which is the primary international benchmark we look at, up 8% last year. Emerging markets, up 18.5% last year, very similar to the S&P 500. The Russell 2000, which is small caps, up nearly 20%, with really all of that coming in November and December. Leading into October, that index was, or leading into November, that index was actually quite negative. But small caps traditionally will lead the way out of the gloom, and so I think we're seeing a little bit of that. But a big part of it, of all of these is obviously vaccines. We'll get into more of that. Bonds last year had a very strong year again, so up 7.5%, which is kind of a neat trick when interest rates are at 1% and 2%. How do you get 7.5% out of bonds? Well, it's because interest rates fell. When interest rates fall, bond prices rise. So it's a little bit of an inverse relationship. Same with dollar and gold. So the dollar fell 6% last year. We kind of see that as a little bit of a trend, which improved gold prices as well. And some of that has to do with all the massive government intervention that's been in play, which we're going to talk a bit about that too. So let's, taking a look at again, more market return data for last year. If we look at it from month to month, again, what a roller coaster ride. So, the beginning of the year, we had some pretty substantial drops with the S&P declining at one point over 34% back in March. After that bottom, though, the government started with its intervention practices, and the market really reacted well to that, having some pretty good runs through the summer. But then leading up until the election, markets started to pull back a little bit, and in fact, at one point, had given up all the gains for the year. Then after the post-election, we get that big chunk of uncertainty out of the way, although it took a little while to get there. We did get the majority of the uncertainty out of the way after the election, and then the announcement of vaccines in mid-November was a true game changer, and I think it's a true game changer for the markets and the economy going forward. That's obviously what's going to allow us to get back to any sense of normalcy throughout the globe, and again, that the markets reacted extremely positively to that, and I think are continuing to react positively there. If we look at sector to sector in the S&P 500, again, a little bit of a wild ride. While Jason said, it wasn't all technology, it was a lot of technology. Technology makes up a big chunk of the S&P 500, about 25% of the S&P 500. Those names are up 43% last year. Big difference between that and the worst performing sector, which is energy, which was down 33% last year. That may be the biggest difference ever on record between the best and worst performing sectors. Another big piece of disparity in the market was growth versus value stocks there at the end of the chart. Growth stocks up 33%, while value stocks were basically flat for the year. Really, they had value stocks had a big rally at the end of the year post-vaccine announcement. Prior to that, were pretty substantially negative, and growth stocks were actually more positive, so the disparity was even greater. We saw that gap close a little bit, but still a huge difference between growth and value. And that's a trend that's been going for a long time, and a trend that we think may reverse course a little bit, at least this year. Again, as the economy opens back up and some of those value names that have been underperforming are poised to perform hopefully a little bit better going forward. So that's the market. Let's talk about what the economy looks like right now. So we are very much experiencing a V-shaped recovery. This was largely predicted at the beginning of all of the mess. Ben Bernanke was the first one that I saw who said that we're going to see a very sharp drop in GDP followed by a very sharp recovery, very much like natural disaster. He compared it to a natural disaster type recovery, and that's very much very similar to what we're seeing right now. But it's really interesting that we had this nice even 2.5% trend growth for the last several years, and not to get political, but this is really the entire Trump presidency here, where we had a very steady 2.5% GDP growth. The economy is actually in really good shape, although it was showing some minor signs of, or not even minor signs, some signs that there might be a recession coming. We just certainly didn't expect it to take the form that it did. Leading into 2020, we did see that there was a yield curve inversion, which is a scenario where short-term interest rates were a little bit higher than long-term interest rates. Traditionally, that's a very strong indicator of a recession. Additionally, it had been 10 years since the last recession, And so we were really overdue for a recession, but again, who could have expected anything like what we've had? But again, it's very much incomplete, as this graph shows. We're still got a ways to go to get back to that trend line. Now, expectations for next year, consensus expectations are around 4.3% GDP growth. The Fed's expecting something along those lines as well. But if you look at all of the market participants and the GDP expectations, they're all over the place. Some as high as 7%, some as low as negative. I mean, it's just all over the place. But in general, the average of the consensus is around 4.3% GDP growth for next year. To get back to that trend line, we're going to need something a little stronger than that, probably more like 5.5% GDP growth. So it may be a year or two before we get back to that. So we'll just see how things progress. But I will tell you that the market right now is pricing in a lot of that expected growth, and we're going to talk a little more about that going forward. So how do we get back to how do we achieve that significant GDP growth? Well, one of the things we need to do is make sure that consumers are in good shape. Consumerism is 68% of our GDP. That's you and me and everybody else shopping at Walmart and Target and Amazon and Kroger and spending that money rather than saving it. That makes up a huge chunk of our economy. We take a look at the unemployment rate. Obviously, employment and wages are part of what's going to keep the consumers in good shape. The unemployment rate spiked to almost 15% back at the low point back in April, and that was the fastest spike in unemployment in history, followed by the fastest recovery in jobs in history. We're actually now sitting, the last measurement was around 6.7% unemployment. The next measure is expected to be something closer to 6%. And really, if you look at the 50-year average of the unemployment rate, we're pretty much right on top of it. 6.3% is the historical average. Ideally, we'd like to be a lot less than that, or a little bit less than that anyway, but really, we're not too far off historical average right now. Still got a ways to go, though. Again, an incomplete recovery. So how did we get back there this fast? Well, it was no small feat. We talk about government intervention. First, you talk about monetary intervention. This is what actions that the Federal Reserve takes. Excuse me. So the Federal Reserve has taken a number of steps to make sure that there is ample liquidity in the system, and there is, trust me, ample liquidity in the system right now. You can see all of these different programs, funding initiatives, and just all, additional quantitative easing, which is essentially money printing. There were 9 new emergency funding programs that were targeted towards very specific areas of the financial system. So the Fed took a lot of what it learned from the financial crisis back in 2008 and put it to work in this crisis. And again, the fact that financial institutions were in such strong shape because of all the work that was done post-financial crisis to shore up finances and make sure that our financial institutions were liquid when the next problem came along. All of that work has really paid off here. So again, no small amount of effort has gone into this recovery. If we look at the fiscal side, so the fiscal side is what has Congress done. This is where the money spending comes in. So yeah, $1 trillion here, $1 trillion there, sooner or later you're talking about some real money, right? But you look at all of these different federal programs that were put in place, and it has been absolutely massive. So the first couple of things, the phase 1 coronavirus preparedness response, which was funding to help contain the virus and develop treatments, was $8.3 billion, which is not much compared to these trillions of dollars that we're spending. Phase 2 was the Families First Coronavirus Response Act, which was $100 billion, which normally you'd think that's a lot of money, but no, not really. You look at the phase 3, this was the biggie, the Coronavirus Relief Aid and Economic Security Act, which is the CARES Act, $2.2 trillion. $300 billion of which was payments directly to individuals. Those were those stimulus checks that everyone got in the mail. It also included the PPP, Payroll Protection Program loans. It also included funding for state and local governments. Again, phase 3, the Payroll Protection Program increase. So that was sort of the second go around with PPP loans. Now we're on another go around of PPP loans based on the December 27th, $900 billion act that was passed, which again gave more stimulus checks to individuals. Additionally, helped businesses, particularly the airline industry, entertainment venues. Again, more funding for schools and colleges, more vaccine procurement expenditures. So massive amounts of spending have gone into this. So, what does that do to us? Well, here is our total public debt as a percentage of gross domestic product. So coming out of the last recession, out of the financial crisis, our debt to GDP really spiked up. And it's been hovering around 100% ever since, maybe a little bit higher than 100%. I think it was at 106%. We spiked as high as 135% of GDP. Our debt has grown from somewhere around $21 trillion to now close to $28 trillion. I think it's $27.8 trillion of debt now. So we have massively increased our national debt basically overnight, blink of an eye. Good news is we're not alone. I guess that's good news. I don't know. But we're certainly not alone in this. Pretty much every other country in the world has taken extraordinary measures to, again, fight the same COVID fight that we're fighting. And in fact, if you look at what we've done relative to all of these other countries on this chart, we're really just sort of middle of the pack. Italy, Germany, Japan, United Kingdom, they've all taken even greater measures. So it's really been an incredible global effort to keep this economy going in a period of time when we really had to shut down the global economy completely, which is amazing that even happened. So there's actually a school of thought out there that I think has become very popular among particularly politicians, but modern monetary theory. Some people also call that the magic money tree. Which basically says you can print as much, as long as you can print money, then you can borrow and spend as much as you want to. And that sort of works, I guess, when interest rates are low. So right now, what this chart shows is the, basically the cost of our national debt relative to GDP. So when we're at 0% interest rates, it's not too bad. But when interest rates start going up, that's when the pain starts. And that is going to create some, I think, pretty significant problems down the road. But it's going to be a while because I think these low interest rates are going to stay with us. And frankly, all of this additional debt that we've taken is going to, give some extra incentive and some extra pressure on the Federal Reserve to drive those rates low. So you take a look at some of the other actions. So, that's what the fiscal policy has done to us, is increase the national debt. What the monetary policy has done to us is increase the Federal Reserve's balance sheet. So, the Fed controls the money supply in two ways. One, by manipulating the short-term interest rates, Fed funds rate. They've reduced that to 0, so that doesn't give them, there's not much they can do beyond that other than go to negative interest rates, and they certainly are not going to do that, thank goodness. The other thing they can do is open market activities where they are going into the market and they are buying securities. So traditionally, they've only bought treasuries. So if you look at the beginning of this chart, treasuries are really pretty much everything that they were purchasing. Going into the financial crisis, they expanded into other things, mortgage-backed securities, municipal bonds, other things like that. For the past few years, the Fed has been tightening the money supply by doing two things. One, raising interest rates a little bit, and two, allowing some of this debt that they've acquired through their open market activities to simply bleed off the books. So as these bonds are maturing, they're simply, rather than reinvesting those bonds, they're just absorbing that money back into the Treasury. Going into this crisis now, they've greatly expanded this. They've greatly expanded their open market activities and have greatly expanded the balance sheet. So what that's done is it has greatly increased the money supply. So this is the M1 money supply. This is essentially money sitting in checking accounts. And you can see how much this has spiked since the financial crisis, but certainly overnight here with this latest crisis. An incredible increase in the money supply. Is this inflationary? Yes, it should be inflationary. The Fed, though, is fighting deflation right now, they'll tell you. I was on a conference call with the Indiana Bankers Association earlier this month. Several of us sat in on their economic conference, and one of the speakers was the president of the Federal Reserve Bank of Chicago, Charles Evans, and he said, "Look, we would love to have we haven't seen substantial inflation in years, and we are doing everything that we can to create some inflation. It's a lot easier to fight inflation than it is to fight deflation. We know how to fight inflation. So when they start to see inflation, they'll start to raise interest rates. They'll start to taper off some of those bonds that I just showed you on the books, and they can fight it in that way. So right now, they are not worried about inflation, but I would tell you that all of this activity is very inflationary. It should be anyway. So I would think that we can expect that going forward. But the other thing that it's done is it has put the consumers in a very good position. So, you know, there's a lot of unusual things with this recession. You know, going into a recession, you would normally expect consumer data to get worse. You know, you would expect a higher unemployment rate. You would expect lower, declining wages. You would expect to see, a worsening consumer balance sheet. But because of all this extraordinary activity, we're seeing quite the opposite. All of these programs, the PPP program, the expanded unemployment benefits, they have all been done to keep the consumer and households in good shape, and it's worked. If you look at consumer balance sheets, they're in fantastic shape. If you look at household debt service ratios, so how much your debt is as a percentage of your disposable income, it's in the best shape it's ever been in. Household net worth is higher than it's ever been by a long shot. Even the debt that consumers have, which is a very small percentage of the total picture there, it's good debt, it's mortgages. That's the kind of debt that you want to have. We look at some other metrics. We look at, again, real personal income. Typically, again, during a recession, you would expect to see a decline here. So if this gray bar is a recession. You can see pretty much a declining trend line there. Going into this recession, the numbers have been all over the place, but again, we're sort of back on trend growth here. We look at delinquency rates on credit cards. We would normally expect those to climb up in a recession. You go back to the last two recessions, they kind of climb up during and leading into the recession. You get into this recession, delinquency rates have declined substantially. That's thankful to you can thank these government programs. Again, folks are taking that extra money that they're getting in their unemployment checks. They're taking that extra money that they're getting in the stimulus checks, and they're putting those into their credit card payments. You look at personal consumption, again, you would expect that's going to taper off during a recession, and we kind of did see that. And, actually a pretty substantial spike in a decline in personal consumption. And again, it hasn't come back all the way. So that tells me that there's some pent-up consumer demand out there. And as part of the ongoing recovery, we can probably expect that there's going to be more consumption as we get into further into this economic recovery. So let's take a look at the stock market again for a second. So stock prices, wow, stock prices are really elevated right now. We've had a huge recovery from the bottom. So from the bottom back in March to the end of the year, up 68%. So we're probably up a little over 70% from the bottom of the market at this point, which is just an incredible run in a very short period of time. And what we're seeing is the stock prices, one of the metrics that we use to to gauge whether stocks are priced at reasonable valuations is the price-to-earnings ratio. The PE ratio at the end of the year was at around 22 times. That's a level that we haven't seen since the dot-com era, which is a little frightening. Because we all remember what happened. The stock market crashed, declined 49%, and really didn't recover the peak for about 10 years. So hopefully we're not in for that again. I think, reluctant to say it's different this time, but I do think it's different this time. I think that, again, all of the liquidity in the system is going to be helpful going forward. I think that these earnings numbers are going to improve. A lot of that's already priced in. I do think that that's probably going to dampen returns going forward a little bit, but I don't think that it means that we're headed for another huge extended market crash. I do think that it's going to lead to some volatility this year, certainly. I think, the market is priced for expectations that we're going to, have a lot of really positive things happen this year. And so whenever we get some negative news, I think it's reasonable to expect that the market's probably going to pull back a little bit, at least on that. This chart, shows sort of the same thing. Again, historical 25-year PE ratio is around 16 times, again at 22 times now. We look at some of these other valuation metrics, and they all pretty much tell us that the stock market's a little overpriced. But part of the reason why markets are overpriced is that there's really no alternative. The alternative to investing in stocks is investing in bonds primarily, and this earnings yield spread metric tells us that bonds are actually very expensive right now, and stocks are still a decent value relative to bonds. So again, there's just not a lot of alternatives, so that's driving prices higher. Something else we've been looking at this for a while, is the valuation of domestic stocks versus foreign stocks. Domestic stocks are really expensive relative to foreign stocks. So again, at 22 times U.S. stocks, you look at the P ratio on foreign stocks, it's more like 16, 17. And what I find most interesting about this chart, if you go back, if you just kind of look through here, we talk about the the lost 10 years that we had in the stock market post or pre-financial crisis. The foreign stocks still haven't recovered their all-time highs back in '08. So you're talking 12, 13 years now. These stocks are still below their peaks. We think that a declining dollar, valuations stack up for probably a pretty decent year for international stocks going forward. Combine that with a global economic recovery. And so one of the things that we've been doing in our portfolios, at least in our models, is that we've been increasing our foreign exposure ever so slightly to take advantage of what we think is a pretty attractive looking market for foreign stocks. Again, going back to bonds, this is sort of the history of the Fed funds rate. And, it seems like, I can't even remember when interest rates were at 5%, but here they were back in '07. Money market yields are up around 5%. It's just hard to even remember that being the scenario. It feels like we've been at these 0% interest rates forever. The Fed back in I think it was into 2014 started increasing, trying to stair step up the interest rate somewhat. Had gotten it, up to up over 2%, and that's again when the market started telling us, maybe we've gone a little bit too far with this, and that's when we had that inverted yield curve, and then we had the recession. And now we're back at zero. Fed projects that we're going to be at these low 0% type interest rates on the Fed funds rate probably into 2023. So that's really a pretty long time. The Fed's also predicting some pretty, I think, rosy expectations for GDP going forward, as well as the unemployment rate. They're expecting the unemployment rate to be back at 3.7%. In 2023, I think this little bit higher unemployment rate is probably going to be a little tougher to get off of this time around. I think there's a lot of factors that are going to keep that unemployment rate a little more elevated than what anyone would like it to be. I think a lot of employers have learned how to operate more efficiently with fewer employees. I think we're going to see more automation going forward. And I think that if we, now that we have a Democrat Congress, we're probably going to see an increase in the minimum wage. The minimum wage increase, I think, will lead to a higher unemployment rate. Folks that own fast food restaurants are going to be adding in more kiosks and hiring less people if they've got to pay them $15 an hour. It's just the way it's going to work. So I think that unemployment rate is probably going to be a little bit of a tricky thing going forward. We look at Treasury yields. It's sort of disturbing. 20-year Treasuries yielding 1.45%. You have to think inflation is going to be running a little bit higher than that, probably over 2% over the next 20 years. Given everything that's in play, the Fed has simply stated that once inflation starts, they're going to let it run for a while, and they would like to see an average of 2.5% inflation, and we're a long way from that right now. So in order to get that average, they're going to have to let it run above that level for an extended period of time, and they've stated that they're going to be willing to do that before raising interest rates to stave it off.
Lee, you want to empty the dishwasher?
So if these interest rates stay at these levels, you're really going to be losing money on a real dollar basis investing at rates at these levels. So for that reason, we're staying away from treasuries for the most part. For our clients, we're typically buying corporate bonds now that are going to have at least a little bit higher yield and give you a chance of earning some sort of money while maintaining some safety in your portfolio on an after inflation basis. Okay, so threats to the market. So I think going forward, that valuation thing is certainly a threat. The market is priced for some pretty rosy expectations. And so if we have any problems, so problems with vaccine efficacy, problems with vaccine distribution, any aggressive tax reform coming out of Washington or any aggressive regulatory reform, I think would be negative for the markets. Any unexpected interest rate increases. So right now, the market is certainly not expecting any kind of interest rate increases. So if we have anything along those lines, that would be negative. Disappointing corporate earnings, disappointing economic data, and then there's always some sort of unknown threat that comes in and causes problems. And again, I think that if any of those things happen, we're probably going to see a bit of a correction in the market. But I will tell you that overall, we are very positive for the market going forward. We think that there are greater macro forces at play that are really, really going to drive the markets. All that massive liquidity that we talked about in the system, further Fed accommodation, don't fight the Fed is the old adage. Vaccinations, again, huge game changer. That gets everybody back to work. That gets us all back to, being able to travel, being able to do all the things that we like to do and spend money. And again, the consumers are in such good shape. I think that all that pent up, wanting to get out and do this and that is really going to be a big deal. And I think that's really going to drive the markets going forward. So overall, again, we are fairly positive, but certainly not without a little bit of skepticism. So that's my presentation. Thank you very much. And I guess we'll introduce Alex Say.
No, thanks, Damon. I appreciate it. And your presentation was more upbeat than if for those of you that have been watching the news, maybe a little too much CNBC or whatever it might be that is your favorite channel. You probably are thinking that 2021 wasn't going to be much better than 2020. So it is good to hear that there are some things out there that look promising. And as you already know, if you're working with Stockyards Bank, we build portfolios to be on both sides of what's happening. So obviously we like to participate in the upside, but it's always the unknown. So Damon mentioned a lot of positive things out there, but it's that unknown that's still lurking around the corner that's probably the most dangerous. And, because of the way we build portfolios, his team selecting stocks, we try to protect ourselves for that unknown and that downside. So again, I'm going to save questions for the end. So please keep it in the back of your mind if you had any questions from what he had mentioned. With that said, I'm going to bring on Alex Say, and he will take us through kind of the changes that we're going to see with estate taxes potentially. And again, I'll let questions be shared there at the end. So Alex, it's all yours.
All right, well, thank you. I know everybody sort of felt a little better with Damon's upbeat presentation. I'm afraid mine might not be quite as upbeat as Damon's was. Obviously, 2020 was a very strange year for everybody, both politically, both financially, and with Democratic control of the government, we're going to face, I think, a little more uncertainty as far as taxes go. I'm going to briefly focus on a portion of income taxes today, but primarily want to focus on the estate taxes because what we have seen is a pretty dramatic proposal from the Biden administration during the campaign. To date, since he's been sworn in, the president hasn't put out any tax legislative proposals or any concepts or plans for tax changes, but we expect to see them coming up very soon. The biggest thing with the estate tax is that it is going to be a huge departure from what has been in place for the last 4 years with Donald Trump. And the other problem is we don't know when the Biden tax laws, if they pass, will go into effect. For instance, most times when a tax law is passed, it is retroactive to January 1 of the year that it's passed. And part of the problem here is that the Biden tax proposal proposes some very dramatic changes to the capital gains tax. So, for instance, right now, for a wealthy family or a wealthy investor, you don't know what that tax law is going to look like. You don't know that it's going to be retroactive. So when you're doing some planning, it's very difficult. But even more so, for instance, if you sold a stock today, I can't tell you what the capital gains tax will be on that stock. I can't tell you if it's going to be the Trump tax rates. I can't tell you if it's going to be the 23.8, that's the 20% plus 3.8% Obamacare tax, or if it's going to be the higher ordinary income rates that Biden has proposed. So let me just kind of give you guys a brief overview of what is in place, or what was put in place during the Trump administration. And that all started in 2017 when Trump's tax laws went into place, and it increased the exemption to $11 million per person, or 22 as a couple. That it was indexed for inflation. So as of right now, everybody in this country has $11.7 million exemption, or $23.4 million as a married couple. What's interesting is when that law passed, not a single Democrat voted for the Trump tax laws. Biden has vowed to repeal it, and even if they can't get it repealed, that the Trump tax laws for individuals will sunset anyway at the end of 2025. So really one of the biggest things that we look at when we look at the estate tax is the step up in cost basis. This is a long traditional tax law that has been in place for many, many years. And it basically says that when you die, all of the unrealized gains in your account basically are not taxed, and the basis of your assets steps up to the fair market value basis on your date of death. So for instance, let's give an example of a family with a business. If they have built a business up over the years, they pass away and the business and their other assets are worth $20 million, perhaps with a $10 million basis, that the basis automatically adjusts under current estate tax law to $20 million so their kids can inherit the business. They don't pay any capital gains tax. They can then sell it without the worry of the capital gains tax, or they can continue running it, make a profit, and sell it later. But there's a couple different proposals that Biden has in place with regard to capital gains tax. First of all, he wants to tax all unrealized gains at death, all right? So what this is effectively you're going to lose the step up in basis, and if you have an estate with let's just say $8 million with a $4 million basis, you're going to have $4 million of capital gains recognition upon death. So what does that mean? It basically means that you will pay the tax. That's on top of the estate tax. The way the Biden proposals work is the tax will come off the top, the capital gains tax, but his capital gains tax isn't even going to be the 20% that we've seen under the Trump administration. What the proposal is to move that estate tax for people with assets of over $1 million, to move that up to a 39.6% ordinary income rate, and on top of that, to add another 3.8% Obamacare tax. So effectively, you're looking at a 43.4% capital gains tax at death on all unrealized gains. So that is huge. That is a major change in the tax laws. We've never had capital gains recognition upon death, and it can result in a significant tax bill for a lot of people, and that's before you even get to the estate tax. What Biden is also proposing to do is to turn back the clock on the estate tax back to 2009. What he would like is an exemption of $3.5 million per person with a tax at a 45% rate, as opposed to the 40% we have today, on anything over the exemption. So, for example, today, if you passed, or I should say, today, if the Trump tax laws don't change and you passed away with $23.4 million, as a married couple, you would pay no tax. You would pay 40% on everything over that $23 million. What Biden is proposing is to say that as a married couple, the first $7 million goes free of estate tax, that's $3.5 million per person, but everything over that $3.5 million will be taxed at a 45% rate. And, you know, when you look at that, and there's some charts I've done, and we can certainly get some materials that I've prepared, sent out to everybody that's on the call. But what it basically means is that if you're a married couple with, say, $23.4 million, and let's assume you have a basis of $10 million, right off the bat, under Biden's proposal, you would get hit with a 43.4% tax, capital gains tax. So that would cost you $5.8 million. That means you'd have about $17.5 million remaining with an exemption of $7 million. So take that off, you've got about $10.5 million now subject to the estate tax at 45%. So that's another 4.7% in estate tax. So you would have total, on a $23 million estate, you would have total taxes paid of $10.5 million. And it would only leave $12.8 million for your heirs out of the $23 million that you had. And this effectively gives a 45.2% estate tax. But let's take that down a little bit lower. Let's just say you've got a married couple with $10 million of assets. This is a small business owner. He's built up a business over the years. He's got a basis of $5 million in his $10 million estate. He's going to pay, again, that 43.4% tax on the $10 million, on the $5 million of gain. So he's going to owe $2.1 million right off the bat in capital gains tax. He's still going to have another $800,000 subject to the 45% estate tax. So of his $10 million, he'll pay $2.5 million between capital gains tax and estate tax, leaving $7.5 million to go to children. You know, it gets even worse for someone who's an individual that isn't married, doesn't have an exemption they can share with the spouse. using that same scenario of $10 million, you would have $4.2 million of taxes paid, basically effectively a 42% tax rate, with only $5.8 million available to go down to your heirs. All right. So when you look at what Biden is proposing, and you look at the levels of tax that are being proposed on someone's estate when they pass away, I think you can say that's pretty significant. And most economists, when you look at it, say, this estate tax and capital gains tax combination, this is really a second or even a third layer of tax on the same income that someone has earned and built up over their lifetime. The interesting thing is, when these proposals are being put in place, and when you're out on the campaign trail, these were presented as, these are tax the rich laws. Let's tax the rich. So you really have to question what economic effect does that have? To Damon's point, what effect will that have on the economy? What effect will that have on the country? And the Tax Foundation, which is a nonpartisan nonprofit that basically examines the economic impact of estate taxes, has looked at this. They've looked at the Biden proposal, and they've said, yeah, okay, this proposal will raise $280 billion over the first 10 years if it's put into effect. So you think right off the bat, okay, there's $280 billion going to the federal government's coffers. But what they've said, though, is that estate tax will actually have a cost to the economy of $46 billion annually in reduced economic activity. These are people who would be hiring people, expanding their businesses, et cetera, who are now going to be affected by the estate tax and the new capital gains tax. And so it's actually going to cost, over that same 10-year period, it might raise $280 billion for the government, but it's going to cost the economy $460 billion. So the question is, what is likely here? We don't know exactly what the tax legislation is going to look like. We've got what Biden has proposed during the campaign. A lot of that can be campaign materials. But what is most likely to happen? I don't think that the capital gains recognition is going to be able to pass. This is just my thoughts on it, based on a lot of things I've seen. But the step-in basis is a pretty ingrained doctrine within the estate tax world. I just don't see that there's going to be the willingness to put that level of tax upon individuals at death. The other thing is the difficulty of determining that capital gains tax. I mean, how many people, yes, if you've got marketable assets, you can pretty readily come across and see what your basis is. If you've got a business, presumably your accountants are tracking the basis of that business. But people have a lot of other assets that they have that they don't track the basis on. Who tracks the basis of their home? Have you tracked how much you paid, what you've put into it in improvements? Are you keeping a running total of that? There are many other assets that people don't track the basis on. So it's going to be pretty tough for people to figure that out. So I don't think that's going to go away. I think we'll keep the step up. I think what is most likely to happen with regard to the estate tax is that you're going to see this idea that's permeating through the Democratic Party, and I'm not trying to get political here, but the idea that let's wipe Trump off the books. So I think more likely, rather than seeing the estate tax proposals that Biden presented on the campaign trail, I think what you're likely to do is to see the undoing of the Trump tax laws. Basically going back to the Obama-era legislation, which would be a $5 million exemption per person, $10 million as a couple, and probably with a 45% estate tax on anything over that $10 million. It's going to be tough here to do any tax legislation. As we've seen today, there are at least 2 senators on the filibuster arguments with McConnell and Schumer that have stepped across the line and basically said they don't support eliminating the filibuster. So it's a little bit of a up in the air call at this moment to say exactly what's going to happen when any tax legislation is passed. I think it's important for everybody to understand what is being proposed. because it is such a dramatic change. If those do go through, there's going to be a lot of estate planning that needs to be done for people, particularly people that have assets in excess of $1 million. So, going forward, I think we're going to be monitoring this very closely. We'll be pushing out materials as we hear what's happening in Washington to keep everybody apprised. If you've got accounts here at Stockyards, your advisors are going to be talking to you. I think this is definitely the year to pull out your estate planning documents, go through them with your advisors, go through all of your assets with your advisors to really determine is what effect will this have on me? Is there some planning that can be done? Is there planning that I need to do? And what effect can this have to achieve some tax savings? So, that kind of is not the greatest news. I know Damon's presentation was a little more upbeat. Mine is a little more sober in summary, but I think going forward, the key is to watch the tax issues, watch what's going on, and make sure that you are aware of it and keeping your own estate in mind. So with that, Ed, I'm going to turn it back over to Jason.
Awesome. Thanks, Alex. Appreciate the comments. Again, for those of you that are listening, I know, the last couple of WebExes have been kind of similar. I spoke to it, Alex has spoken to it, and as he just kind of wrapped his presentation up, there's so many unknowns, but we want you to know what there is out there so that you can start to plan for it, hopefully not having to take as drastic measures as, potentially it sounded like at one point that you have to. As we come across new information, maybe it'll be another WebEx, maybe it'll be materials that'll be directly emailed to you. We're going to keep you privy of all that as it develops. But right now, the best we can do is plan for it and see what happens. Now's the time, though. If you've got a question, I'd ask that you can chat that to us. You can unmute yourself and ask a question via the phone line. I do have one question for you, Alex, just for clarification on the capital gains. Is the proposed increase, is it based off $1 million of income or $1 million of assets?
Well, there's actually two proposals.
Okay.
There is a proposal from an income tax standpoint where basically if you earn more than $400,000, less than $1 million, you would get the current rates at 20% plus the 3.8% Obamacare tax. But, there also is a proposal to basically say, let's move those capital gain rates, not just based on the income levels, but on asset levels. And so Biden also wants to basically take the capital gains tax for millionaires up to ordinary income rates. So rather than that 20%, and it's kind of hard to imagine someone earning between $400,000 and $1 million a year is going to have assets of less than $1 million. So most likely what the proposal is saying is that if you are a millionaire, the capital gains rates will be pushed to ordinary income rates, which Biden wants to increase the top tier rate to 39.6%. So you take that 39.6 plus the 3.8 Obamacare tax to get 43.4. So most likely it's looking at assets over $1 million at having higher ordinary income rates for capital gains tax, both on a income tax standpoint and an estate tax standpoint.
Okay, awesome. And then just so everyone knows that is listening, Damon's presentation and what Alex spoke to, and I was not able to get that pulled up so that you could see it, and it probably would have been too small on the screen. We will get that out to you by the end of the week so you can see all the examples that he spoke through in greater detail and read that. Again, if you have questions, even after today, I'd suggest that you either go directly to your advisor or you can always email us at WMTquestions, which is plural, at syb.com, and we'll follow up with you to answer those questions. There is a question coming through about 1031 exchanges and speculation of Harris's administration, the impact of Harris being in the administration. So, Alex, I'll let you, if you want to answer the 1031, and Damon can.
Yeah, no, I haven't seen anything yet, you know, and to be quite honest, I haven't dealt with the entirety of some of the income tax changes, but I haven't seen anything yet that's been proposed on changes to the 1031 process.
So the only thing I can say to that is early on, and I don't know if it's still on the books out there, but they did possibly throw out 400,000 and more in income. 1031 exchanges might go away, but that was mentioned early on, and I don't know if that's still surviving some of the writings out there or not. So we'll have to see how that goes. Damon, you have any comments on your thoughts of impact of the Harris administration?
Well, again, we're, I mentioned, any aggressive, tax law changes or any aggressive regulatory changes, I think would be a negative for the stock market. And again, I think a lot of that is going to be put in check by, a narrow margin in Congress for the Democrats. And again, in terms of regulatory pressure, a lot of this green stuff that's been talked about for a long time, I know one of the key things is going to be environmental and social and governance disclosures. That's going to be, that's already a process that's been in the works for a while. So all of the big companies have really been doing a pretty good job of at least the disclosure stuff. And I think, there's definitely room for improvement there. But they've all been working in that vein for a while. So a lot of these things have already been in the works. It may get some publicity of some things getting done along those lines. But again, a lot of that stuff has already been worked on. Now, if there are a lot of, again, regulatory type pressures that are real and meaningful, those kinds of things I think will have a negative impact on the markets.
Right. And my 2 cents to that would be also, as we saw in the news today, and I'm drawing a blank on the senators, I think one out of Arizona, maybe the other one was out of West Virginia, the Democratic senators that said they would not be in favor of busting the filibuster. I think that is also probably in play from allowing anything drastic to really happen. I think this question might be a little bit more toward the speculation of, what if we had a Harris take over a Biden position? So I think there's a little bit of a roadblock there. It looks like all the questions from chat. Does anyone, I'll give last chance there from anyone on the phone lines that would like to ask a question. Again, a reminder, we will send this out. We'll send the recording with the presentations along with it, so you can share it if you'd like, or re-review what we went through today. From all of us at Stock Bank, we very much appreciate you as a client and the trust that you put in us. We'll keep these WebExes going. I don't know that it'll be every month, but you'll just be on the lookout for communication in the future. We're going to try to keep it pretty consistent and keep you informed. And the ultimate goal at the end of the day here is that we are providing value and informing you of, relevant topics out there. Again, if you have suggestions on things you'd like to hear from us, again, wmtquestions@syb.com. I'm happy to entertain and listen to anything you have or would like to hear about. So with that, I hope everyone has a great evening and a great rest of the January before February kicks in. Take care, everybody. Thank you.